Bloomberg Audio Studios.
Podcasts, radio, news.
This is Bloomberg Businessweek. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news. The Bloomberg Businessweek podcast with Carol Massar and Tim Stenovec from Bloomberg Radio.
All right, everybody, shares of Micron Technology, they are the biggest decliner in the NASDAQ 100. They are right now down, I think, about 16.5%. Yep, pulling it up just off their lows of this session. So big hit, down the most in more than 4 years since March of 2020. And this is coming after the largest U.S. maker of computer memory chips put out a revenue forecast that missed projections, reflecting sluggish demand for smartphones and personal computers. And then there's also a headline involving Intel that we kicked off our hour with. So we've got a lot to talk about when it comes to the semi space.
Yeah, what we need to know when it comes to Intel, Micron, and the broad world of semiconductors. Here with us is Bloomberg Intelligence semiconductors analyst Jake Silverman here in our Bloomberg Businessweek studio. As Carol mentioned, Micron selling off big time, 16.5% to the downside right now. Worst day going back 4 years. Sluggish PC and smartphone demand. Yesterday when this broke, I was thinking to myself, didn't we know about sluggish PC and smartphone demand? Why is this such a surprise?
Yeah, so part of that is that it's more so an inventory correction than it is actually a change in demand profile suddenly. So over the last, it seems like maybe 6 months, 5-6 months, there was a buildup of inventory.
Which happens in the semi space.
Yeah, it does. It happens all the time.
Yeah.
It's frequent. You go through up cycles and down cycles.
Right.
And so PC and smartphone customers were building up inventory ahead of price increases, which did occur. And so now what's happening is they have adequate levels of inventory, and demand isn't necessarily that strong. So there's not a lot of demand for Micron's memory chips right now.
So is it kind of like, whoa, investors understand that the reason there's sluggish demand is not that, you know, we've known about the troubles in the PC market, but it's not like everything's going to hell in a handbasket, right? It's just a case of people had built up inventories.
Yeah, sure. No, and there's also something to keep in mind, though, that there's a number of different moving parts. I think there's obviously the AI aspect of it, but people are also, I think, somewhat concerned about just how prolonged this inventory correction will last and how much excess inventory is actually in the channel right now.
Because I thought they kind of checked the box when it came to AI, their AI demand.
Was pretty strong, yeah. I mean, data center related demand grew 46% sequentially. So,
well, remind everybody where they play in this space, where Micron fits in. If you look at the supply chain analysis feature on the Bloomberg terminal, you see that Apple's one of its biggest customers, Dell, LG Electronics, WPG Holdings is actually its biggest customer. Where does it play?
Yeah, well, so it's pretty broad. I mean, every consumer electronics device, everything that, every electronic device needs memory, it needs storage to some extent. And so what's been happening is, over time, over the last several months, last year or so, demand has improved a lot in the data center. So now you're starting to see more demand from customers like NVIDIA, as well as other like ASICs as well, the customers of Broadcom and Marvell, who are also creating their own AI servers or, ASICs.
Hey, Chick, one thing I'm good at, as you said, the data center related revenue did okay. It grew 400% in the quarter. That's pretty okay from a year earlier. The unit now accounting for more than half the company's total sales, but it wasn't enough to offset the weaker orders from makers of devices aimed at consumers. Having said that, is the data center what this company really becomes, that area in the future? Like that's going to be the dominant business?
Yeah, I mean, it depends entirely on how much additional AI infrastructure build-outs occur. If there's continual incremental spend over the next decade or so, But the thing is, high bandwidth memory is an area that they're seeing a lot of demand for, but it's still so early for them. So what you're seeing a lot of the data center demand or growth this past quarter was actually not necessarily all related to HBM. In fact, the vast majority of it was actually like high capacity modules, as well as LPDDR that goes into servers and AI servers. An area that was a little bit of a concern was actually that data center SSDs, though, took a bit of a pause. They've moderated in terms of demand. We're not exactly sure if that's how temporary that is.
Hey, Jake, I promised we'd talk a little bit about Intel. We learned just in the last hour that Intel has shortlisted a number of buyout firms for the next round of bidding for its Altera unit. This according to people familiar with the matter. This is the chipmaker faces headway on a process started by its now ousted CEO. What does our investing audience need to understand about this?
Yeah, no, I mean, I think for Intel, it's just an opportunity to really unlock value. We've seen them do very similar plays with with Mobileye, for example, and one of their other businesses within their foundry. So this is an opportunity for a pretty high margin data center mostly play, but still somewhat diversified in Altera for Intel to get some much needed cash.
All right. So it just sounds like stay tuned. More to come from Intel.
Yeah, I mean, we'll see how much value they can truly unlock, but it is a higher margin business, somewhere around the mid to low 60% versus much lower margins. Well, relatively speaking, for their other businesses like PC and data center.
All right, and I should say that Intel shares are just down a little bit. They were down about 1% at its lows, up 2% at its highs. Right now, down about 0.8%. So kind of bouncing around.
Yeah, the PE firms, including Francisco Partners, Silver Lake Management, are competing alongside with Lattice Semiconductor in a second round for Altera.
All right, Jake, gonna leave it there. Thank you so much, Jake Silverman. He's semiconductor analyst with our Bloomberg Intelligence team.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
AGCO hosting its Analyst Day today and giving an update on its business. Shares of the company selling off the most in nearly 2 months, at least at its lows, down about 4.5% as we speak, after the farm equipment company projected net sales of $9.6 billion in 2025, down from about $12 billion this year. That forecast, by the way, trailing the average analyst estimate of $10.7 billion.
Ahead of that meeting, the company's largest shareholder, Tractors and Farm Equipment Limited, urged management to address several issues, including what they call AGCO's, quote, lagging performance compared to peers, successive quarters of performance misses, and downward revisions in guidance, diminishing competitive position, and value erosion through failed acquisitions.
It's a rough setup, but we're so delighted to have with us the CEO, Chairman, President of AGCO, Eric Hansotia. He's here in studio. We had to lay it out, but you know what's been going on more than most. Tell us, first of all, about the analyst meeting and some of the serious issues that investors wanted to know about.
Well, this is a wrap-up of a pretty amazing year on the one hand, but mostly as a forecast forward. So this year we made the largest ag tech deal in the history of the industry. We sold off our lowest margin, lowest growth business in the grain and protein division and managed through a significant downturn in the industry, kind of one of the most severe in the last 10 years. These things happen, but it was all coming together this year. Now, our analyst meeting was all about forecasting forward. And the first one I did, we made a claim of being a 10% margin, never done that in the history of the company, we delivered. Then last time, 2 years ago, raised the bar to 12%, and we're on track to deliver that. Now we raised the bar again today to a 14 to 15% range, and our team is very confident that we're going to deliver on that.
Eric, you mentioned it's been a quote amazing year. An investor watching right now might have issue with that and say, what are you talking about? Shares are down about 25% so far this year. Where's the disconnect?
Well, it's all about the cycle. So the industry went through that was one of the three things that made it an amazing year. I mean, amazing has both positive and negative.
Good and bad.
Good and bad. So the demand came down a lot, but the restructuring of the company to position it for the future, much more focus on technology, high margin, high growth, less distraction from a low growth business, really sets AGCO up to prosper as the industry comes back. And it will. These industries go through a normal pattern where there's a big correction year. That's the year we're in. We went from about 105% of the cycle down to 90 in 1 year. That's a big correction.
That's pretty rough.
But in 25, we'll probably find the bottom, and then it'll start working back up. And our mission is to control what we can control. We can't control the industry, but we can position the company to be strong on the way back up.
So, Eric, 2025 will be the bottom, in your view?
That's our forecast.
Of the cycle?
That's right.
What about all the kind of global trade, environment, tariffs, trade, geopolitical? How might that change that?
Well, there's a number of balls in the air right now and things that are uncertain. At the end of the day, though, the same number of mouths want to eat. And so grain may shift around a little bit.
Right.
Maybe one farmer's advantaged, one farmer's disadvantaged, but it'll just shift where that grain comes from. We're a very global company. Only 25% of our business is in North America. So if grain moves to a different market, we'll serve it from those markets. So, So a global trade war would not impact farmer equipment purchases, at least for you guys? I understand you're global, but I'm just curious. I don't want to make it that concrete because anybody buying capital goods wants certainty. And so if we have a very uncertain, fast-changing environment, then folks could hold back. But that's different from if the rules shift and say there's an advantage here and a disadvantage there, but they're stable now, that we know the new rules and then we know the new guardrails, then everybody can plan around that. And so I think the uncertainty is the bigger issue than a shift in the framework.
Sort of on Carol's questions about uncertainty and a potential trade war, if we look at the first Trump administration, the way that farmers in the U.S. had to be bailed out as a result of retaliatory tariffs that were put into place by countries during that time, how do you prepare for the next Trump administration? How does that change your business? How does it change your outlook?
Well, we've done a lot of scenario planning, looking at all types of things, because there's two levels.
How many different scenarios?
Oh, over a dozen for sure.
Okay, go ahead.
Yeah, and so the notion here is you have to plan on a couple different levels. One is the cost for the company, but on the other one, it's the impact of farmers globally. And
that's what I was thinking of more so.
So it's the supply side and the demand side, and how do you respond to both of those? So none of it is certain yet. You've got to kind of just decide where it could land. At the end of the day, our major competitors also have very global supply chains. And so to some degree, this will impact all the companies to some degree the same. Now, there could be nuances of elements that will be different.
Right.
But at the macro level, we'll all have some of the same influences. And the global grain will reestablish itself and find its way to the market.
What about production cuts and your production schedules? Is any kind of cuts happening in the first quarter, and then do you see production gradually increasing throughout the year?
Yeah, we expect, we're expecting this downturn, which was very dramatic in 2024, to continue into 2025, probably start finding its way back up. Already Asia and parts of South America are showing green shoots of growth. They were the first to go into the market, they're coming, or go into the downturn, they're coming back out. So yes, the first quarter is going to be probably the worst, as we're underproducing to retail demand to clean out the pipeline of inventory in our dealer network, and then likely recovery in the second half.
I want to take a step back, because I said to you when you kind of walked in that we don't necessarily spend a lot of time talking about the agricultural economy. We just kind of assume all this stuff's going to happen until there's war and we have shortages and we're like, what's going on here? So what is different, Eric, about this ag downturn versus what we've seen in prior cycles, to help kind of people understand?
Well, two things. Number one is how fast AGCO is responding, and I think some of our peers are doing the same thing, but much more aggressive response, way faster action on cost and on inventory. So instead of letting this downturn linger and stretch out, everybody's much more responsive and proactive. That number one. Number two is the role of technology. We just launched a kit that makes an existing tractor autonomous. You can take the driver right out.
Yeah.
It works with the combine, drives up alongside, you unload on the go, and then the tractor drives away. Nobody in the tractor the whole time. So, and artificial intelligence in our sprayers identify the difference between a weed and a plant, only spray the weed. All this technology is making these machines much more capable and making the farmer much more productive. So even though there's ebbs and flows in the market, farmers see the opportunity to make themselves more profitable. Even in down markets, they say, I got to have that latest technology to make myself more efficient. So technology is playing a much bigger role this time than last cycle.
The autonomous technology, is it 100% there for you?
Yeah, we're selling it today. So we demonstrated it last fall to journalists and our analysts, and we're selling them right now.
And are there any regulatory issues around it in different parts of the world? Where can it be used?
We don't
How
take
can
it on
be used?
we don't take it on the road. That's a big difference. So we're staying in the field, and the fail-safe mode, when it runs into in a situation where it doesn't understand what to do, it stops. And so then we can remotely monitor into that machine and say, okay, either pull back and drive around, or go or drive through it.
But because it's not on the roads, it's not regulated at all. So you don't have to worry about any of that stuff?
Largely, that's true. That's right. Fundamentally, the regulations are on road. And that's where the bigger challenge is. That's why some of the automotive industry, they have a much bigger challenge than we do. But our solution fits on multiple brands of equipment. It's a retrofit kit that then can take an existing machine, and you can use it either way. You can either continue to drive it the way you do today, or make it autonomous in many applications on the farm.
I have to say, I've driven a tractor, like one of the big ones, from a competitor. I'm not going to go into it, but it's pretty amazing, these machines.
Just tell us what color it was, Carol. Then maybe we'll know which
kind of bright
competitor
orange.
it was. Okay.
Having said that, I mean, these are not inexpensive devices. So when a farmer or a big company is buying them, they have to think about it, right? And they have to think about what's coming. Talk to us about pricing. What's the outlook for next year?
Well, pricing is we say 0 to 1% pricing with just a little bit of price probably.
Yeah.
It's a low pricing environment with weak demand. We don't see much opportunity to put in price. We priced a fair bit during the COVID time when there's a lot of inflation, but we try and keep pricing just a little bit above our costs. So if costs are going up 2%, we try and price just a little over 2%. So that's usually kind of how the industry operates.
And you stay with that, yeah.
Yeah, that's kind of how it's been going as throughout the cycle.
Where are you seeing in the supply chain inflationary pressures right now, if at all?
We see a little bit of inflationary pressure still, but largely it's muted. The supply chain has healed dramatically. Like our on time and full rating of how the supply performance, it was in the 70s during COVID. Now it's in the mid 90s. It's better than it was pre-COVID. So the supply chain is healed. Everything's flowing nicely. We still have friction in the freight situation where there's areas where we have to go a longer route because of some of the Middle East issues, but not a huge problem. Nothing like we had during COVID.
When you look at markets and regions around the globe, since you are a global company, as you reminded us, where are you most optimistic for the new year?
Well, in the short term, probably Asia Pacific. They went into the market, Australia, New Zealand, Asia, that region went into the downturn first. We're seeing them forecast to come out of it sooner.
Right.
Next would be South America for a couple of reasons. One is just their natural cycle sequencing, but they may have the best benefit of this grain moving around. And their currency is weaker and so on. So Brazil is, big picture, they're probably one of the biggest growth regions over time.
Right.
They have more land to put into production, fantastic climate. They can grow 2 crops a year. So they're essentially, as soon as the combine goes through harvesting, the planter comes right behind it and plants the next crop.
Is it safe to say, Eric, we've talked so much over the last year or two about the pushback on globalization and more nearshoring or onshoring. And that's happening in your industry as well, right? People are rethinking, certainly coming off the Russian-Ukraine war, like kind of rethinking where they're getting their food supplies.
Absolutely, both food supply and then as a company, we're thinking we're changing the same thing in terms of our supplier relationships.
You are.
So absolutely, we've changed more supplier relationships in the last 2 or 3 years than I think we did maybe in the last in the 5 or 10 before that. Lots of change in our supply base.
Hey, very briefly, have you seen climate change affect your business at all?
Well, climate change is a big thing on the mind of our farmers because they have a lot more severe weather impacts.
Right.
And so they have either too much water or not enough water and things like that. So they really want to use precision technology tools to make sure that they're planting with the most efficiency and then managing that crop through the growing cycle. So yes, it's something that we're managing, and we're also helping farmers take advantage of carbon sequestration. So taking the carbon that's in the air, trapping in the soil, and helping the farmers get paid for it.
10 seconds left. We said your stock's down about 4%, so underperforming the market. What do you say to investors right now? Be patient? Real quickly.
Hey, this is the cycle. We're closer to the bottom than anything else. It will come back. It's not a matter of if, it's a matter of when. We're positioned for the future. We're going to come back strongly.
Well, we hope you come back too and continue to give us an update. Eric Hansotia, he is Chairman, President, and CEO of AGCO, joining us right here on Bloomberg Businessweek. This is Bloomberg.
You're listening to the Bloomberg Businessweek podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Okay, we heard a lot from Fed Chair Jay Powell yesterday on the economy, the consumer, and how the Fed is thinking about rates. Here's just a couple of things that he said. Quote, growth of consumer spending has remained resilient. Check. Quote, the economy is strong overall and has made significant progress toward our goals over the past 2 years.
Check.
Check. Quote, we think the economy is in a really good place and we think policy is in a really good place.
Check, check.
Okay, so that's what we heard.
Sounds pretty good.
From the Fed. It does sound pretty good.
Right?
I mean, yesterday's market reaction notwithstanding.
Yeah, exactly.
For a check on how the consumer is doing, let's bring back Silvio Tavares, CEO at the credit data and credit risk analytics firm VantageScore. It's a joint venture of Experian, Equifax, and TransUnion. Silvio joins us from San Francisco. Silvio, I wanted to talk to you because you have so much good data about consumer health. How would you characterize the consumer right now?
Well, Chairman Powell was spot on. The consumer's healthy, and that's good news. That's good news for us as consumers. It's good news for the economy. The challenge that we have seen and the big change is that inflation is more stubborn than anticipated. And that's the big thing that changed. And we heard from Chairman Powell, they're going to keep rates higher for longer. And that means less bank lending and probably less consumer credit utilization as well. Not great for merchants.
Hey, we had Mike McKee on earlier, but he made the point yesterday during his turn to speak that we haven't seen rates come down.
Consumer rates, right?
Yeah, excuse me. Thank you, Carol. Consumer rates come down when we're talking mortgages, when we're talking credit cards, and the like. How are you looking at that over at VantageScore and what that means for your, well, I was going to say your clients, your customers, but kind of like we're all, you have a view of all of us, whether we know it or not.
Yes, very much so. As you mentioned, VantageScore is the largest national credit scoring company, and we take data from TransUnion, Experian, and Equifax to assess the health of the consumer. And lower interest rates, the cut was anticipated. The cut that happened this week was anticipated. And if you look back at November, basically, banks anticipated it, and they actually opened up more credit accounts. New credit card accounts in particular were up modestly in November. But consumers only spent slightly more. Credit card balances were up a little bit, about $30 November compared to October, and about $200 year over year. And so overall, the interest rates and the expected cut tended to increase new credit accounts and increase spending a little bit, but not a lot. And so that's not necessarily bad news. In some ways, it's good news. Consumers are being disciplined about their credit utilization, not getting in over their heads. And banks are also somewhat modestly increasing credit lines, but still being cautious. And we're going to expect to see that continue into next year.
Yeah, I'm just listening to you, and I am curious, the number of accounts being opened, is that a good sign because people can do it and they get approval? Is it a bad sign because people are opening up new accounts so that they can find new places to spend and create bigger credit? So help us understand the data that you get. You get so much in real time, it feels like. What are the words that you use to describe the consumer credit picture right now?
Well, I would say it's healthy. A low credit score for a consumer is 300. The maximum possible credit score is VantageScore 850. And the average consumer was 702 through the end of November. And that's, the earnest start of the holiday spending season. So consumers are credit healthy. And we're seeing modest increases in consumer spending, and we're also seeing modest increases in consumer lending. So overall, steady as she goes, for sure. The challenge is, as you look to next year, the news we got this week from the Fed is they anticipate inflation to be much more a significant issue than before the election. And so that's the main area for concern as we go forward. Is the Fed going to be able to tame interest rates? Because if those interest rates, those inflation rates get out of control, they're not going to be able to cut interest rates as much and as aggressively as they signaled to us before.
You mentioned 702 for the average VantageScore 4.0 credit score. Carol and I just both saying to each other, that seems high, given that the highest you could get is 850. Yeah, is that high? That seems high for average.
You're absolutely right. And it's high by historical standards. And what that tells you is consumers overall are actually very credit healthy. They're managing their credit cards well. They're not getting in over their head on personal loans or their mortgage. And that's a really good thing. And I think that's a bit of what's been lost as we saw the wild swings in the stock market since the Fed announced its 0.25% cut. What's lost in all of that market swooning is the fact that overall, the economy is doing very well and consumers are actually doing very well. And the key problem that the economy is facing is making sure that inflation doesn't get out of control. That's obviously, that reaction to inflation is what impacted the election, and it's the main thing that all the new members of Congress are thinking about. It's what the president-elect is thinking about, and it's certainly what the Fed is focused on, is just managing that inflation so it doesn't get all out of control. But the reality is we got a great economy right now.
Silvio, tell us though, what do you know about the demographics of the folks that, from the data that you get and the credit scores that are issued? Like, what do we know about that pool of people? Because I also do wonder, and something Tim and I talk a lot about, folks at Bloomberg talk a lot about, is the underbanked, folks that maybe can't get that credit card, so they're not even in, that average score statistical bunch, if you will. So give us an idea of what you know about the demographics of your business and the people that you basically rank.
Well, that's one of the advantages of the VantageScore. We actually include a lot of people that traditionally were left out of credit scores. We actually include about 30 million more consumers. Many of those consumers are folks that historically didn't get a credit score, but we're able to score them using our advanced techniques. And, if you think about the average consumer overall, they are in fact doing better than they were a year ago. And they're actually using credit slightly more than they were a year ago. And that's the high end as well as the low end consumer when they can't access that credit. So we're seeing a pretty uniform picture. Overall, consumers doing modestly better than they were a year ago. The key, though, as we look into the new year, what we're expecting is the Fed is going to keep interest rates higher for longer. And what that's going to mean is fewer consumers are going to get new credit accounts, and that's going to disproportionately impact the low end. But it also means that the high end consumer, they're going to be more reluctant to use credit.
Hey, I'm curious about buy now, pay later and those types of firms. The sort of like instant credit that's offered at checkout at places. Are they using VantageScore?
Absolutely. Many of those firms use a credit score to manage the access to new BNPL accounts. However, many of those firms, buy now, pay later companies, they don't provide data on the performance of those loans. And that is a blind spot for the industry that we're working on, because as that has grown, the utilization of buy now, pay later, you want to get the data on whether people are actually paying up in 3 or 4 installments.
Are they?
Well, it's tough to tell. What we can see is that overall delinquencies, that's the industry jargon for whether people pay their credit card loans on time. Those delinquencies are actually pretty good. And in fact, they're better than the pre-pandemic averages. And they're holding steady. We saw that in the most recent November credit gauge. And what that shows is, again, consumers remain credit healthy. We're not seeing a significant deterioration in delinquencies. And that's actually very good news for the economy.
Hey, when it starts to go bad, though, does it all of a sudden turn quickly? Like, do you guys get indications that, all right, we got some trouble here when it comes to consumer credit? Tell us about kind of that ability to kind of forecast. Because I know in some indicators, when they start to go bad, they go bad really quickly, and then they just drop off.
Well, and we've certainly seen that. There's been a period of unprecedented credit volatility over the last 2 to 3 years. Things do change quite rapidly. And it's one of the reasons why we are seeing our customers, banks, our stakeholders in Congress and at the Federal Reserve, we're seeing them turn to more high frequency data. You got to check what's happening in the market more regularly. It's one of the reasons that VantageScore was an industry leader in publishing insights on a monthly basis. We call that VantageScore Credit Gauge. And in fact, we're publishing that tomorrow morning. The data I'm sharing with you is an exclusive that we provided to Bloomberg in advance. But the reality is, if you're a bank, if you are a policymaker, you got to be checking more regularly, because things move quickly. And I actually anticipate that's going to accelerate. Things are going to move even more quickly as we head into 2025. New administration, new regulators, new policymakers, all of that is going to bring more volatility.
Just a few things going on in the new year, no doubt about it. Silvio, thank you so much. Have a good holiday. Happy New Year. Silvio Tavares, he's Chief Executive Officer of VantageScore, joining us on this Thursday from San Francisco.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
So let's talk about kind of what's next for AI.
That low-hanging fruit, the perfect
low-hanging
segue,
fruit.
because that's exactly how our next guest describes what the last 2 years have looked like when it comes to AI. We got with us Rachel Metz. She's Bloomberg News AI reporter. She writes about what the AI giants are doing now that that low-hanging fruit is gone, 2 years after the introduction of ChatGPT. She joins us from San Francisco. Check out Rachel's story on the Bloomberg terminal and at bloomberg.com/businessweek. Rachel, what is the tone that we've heard over the last few weeks, over the last few months from these AI giants? I mean, Anthropic, Google, Meta, OpenAI, about training these models and sort of what's next when it comes to this so-called AI revolution.
Well, it kind of depends who you ask, when you ask them, and how you ask them. But definitely in our reporting, we found that a number of companies, Anthropic, Google, and OpenAI, are having some challenges, I would say, in training their cutting-edge AI models. They are running out of data. They are not having the right kinds of data to train them to what they want them to be. And also these models cost so much money to make. So you really want to make sure that if you're putting a ton of money into something, that it's going to be good enough to be worth it, right? So they're seeing, as we put it, I think, diminishing returns in some cases with their most cutting edge technology. And some people, such as Google CEO Sundar Pichai, have talked about this. And some other people have been, a little bit quieter about it. Like you might see, or they say the opposite. Like you might see Sam Altman on social media saying there is no wall. And I'm like, well, who said there was a wall exactly, huh?
I have to tell you, you saying this, I am obsessed with this story that our Linda Wan put out on December 13th. And I highly recommend, just like Rachel, read everything she writes. Check out this story because it basically said AI wants more data, more chips, more power, more everything. But that concept of more data, I think we thought, oh, the world is awash in data. I give it tons of data every day. And yet there was this concept of actually really useful, smart data that helps AI kind of keep growing and get to the next level. I mean, that sounds like that could be kind of a supply-demand imbalance.
Yeah, I mean, it's important to keep in mind that not all data is created equal. And a lot of the data that is used to build these large language models, which is the kind of AI that powers chatbots like ChatGPT, a lot of it is coming from the internet, and it has been largely scraped at this point. So if you want to make bigger, better models, you need more and more data. So companies are starting to think about, well, where could we get more data from? And some of that could involve paying professionals, people with PhDs or other type of higher degrees to label data for like math models that can be really good at math or coding, things like that. You might look to people in the medical field, like a nurse, for instance, to label data related to medical professions, because you really want to have good data to train these models to be accurate and good at specific things going forward.
Here, why don't you take all this stuff so I won't have a job anymore? Why don't I teach you how to do my job so then
Is that sarcasm, Mr.
Yeah,
Stenovec?
that's just, I know I'm oversimplifying it, Rachel, but I see you're laughing, so my mission is accomplished.
I think there'll still be plenty for us to do.
Okay, good.
I'm so glad. I don't know. So how do you read this? Because I do feel like it has been nothing but, not even a marathon. It's been just a fast race the last 1.5 years, 2 years in terms of the AI spend ramping up. It just feels like anything that came, in terms of AI or when we do earnings, right, we wanted to see, is the AI spending there and so on and so forth. But it does feel like a reminder that all of this is going to take time. How do you think about this cycle?
I think that what you said at the end there is really spot on. It is going to take time. And also, as we've seen in other industries, sometimes the pace of innovation doesn't always, it's not always the same. It goes in fits and starts. Sometimes things are really fast. Sometimes things even seem to go backwards a little bit. I spoke for this latest story, I spoke with Jonathan Frankel, who is a scientist, and he works at Databricks. Yeah. And he said something that I thought was really spot on, and I've actually heard this from a couple people, that we should look to the chip industry. And, the chip industry, we've seen different innovations over time, and sometimes directions change depending on where's the best way to innovate? And that seems to be what we're seeing with AI. And that's what I would expect to see going forward is people trying different things. Sometimes they work, sometimes they don't. And sometimes things go fast and sometimes they go a little slower.
Hey, Rachel, really quickly, 10, 15 seconds. I mean, might 2025 be that, like, I don't know, take a breath, slow your roll, everybody, when it comes to AI. Might that be the 2025 year, or who knows?
I don't think so, actually.
Okay.
I mean, that would be really nice. It would be relaxing for the news cycle, but I think that we're going to see a lot of people working on so-called AI agents. This would be AI software that can perform more complicated tasks with not much help from humans, and some other things that we're going to see companies doing. I think they're really pushing ahead, and we have to remember a lot of these companies still have lots of money to burn, so they're going to keep plugging away.
Well, good. That means we get to continue talking to you. So love. Rachel Metz, Bloomberg News AI reporter. Check her out on the Bloomberg terminal and, of course, at Bloomberg.com.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's the question that drives us.
This is the Drive to the Close
That funky music will drive us till the dawn.
on Bloomberg Radio.
All right, everybody. TikTok, everyone. Almost 20 minutes left to go until we wrap up the trading day on this Thursday. And you've got stocks bouncing around. We are green across the screen, although call the NASDAQ 100 pretty much unchanged, just up a couple of points. You just heard Charlie and Bill Maloney just breaking down the trade. But we're off our best levels of the session, but still up about 0.4% on the S&P. And as I said, the NASDAQ 100 is flat. I know you're going to go to the Dow. It's up about 0.5%.
Oh, well, then, okay.
What?
So now I got nothing.
Sorry. Took it from you.
I got nothing.
Sorry.
But we're talking this week about the losing streak that the Dow has had.
Yeah.
I mean, we're talking one that was like decades until today.
All right. So one thing.
You don't care. She doesn't care. She doesn't care. She doesn't care about the Dow.
I want to talk about private credit because we have a great guest back with us, Ana Arsov. She's global head of private credit and financial institutions over at Moody's. And Ana, I keep thinking about, I don't know, private credit, everybody's all in. Private credit firms are expanding beyond corporate lending to finance areas like auto loans, residential mortgages, chip manufacturing, data centers, So we're talking about a potential market size of $40 trillion. Again, it's a market that many would argue there isn't a lot of transparency. Are there checks and balances as you see it in the private credit world?
First, thanks for having me. I really appreciate, obviously, being a repeated guest. And yes, we are focused on the same point that you're raising. We don't think that there is equal level of transparency in all of the aspects of private credit. And namely, I would probably separate the BDC portfolio, which is business development companies. These are closed-end funds focused on investing in middle market loans that we rate with a lot of good granular disclosure publicly. These are mostly public trading vehicles. There's some privately traded, but really most of them are public vehicles with great disclosure. But that market is roughly around $300 billion, pretty small part of what we estimate $3 trillion north of market growing into the next couple of years. So again, I would say that disclosure is still, it's improving, but not where it needs to be for such a growing market, and particularly growing market that wants to tap retail money.
Where do you think it needs to be? I mean, like, what would make you say, okay, now I'm comfortable with their view that they want retail money? There's enough disclosure there. Like, what do they need to do?
Well, I think that we don't have aligned rules, for example, on valuations of private companies. Every fund can choose its own governance around valuations, which is a very important driver into how this, first of all, portfolio companies are estimated, and particularly the private loans that lend to these portfolio companies, which is usually on loan-to-value basis as well. So again, valuation is an area that we would like to see more coherence and focus on. Transparency, same way of discussing, for example, defaults. In the public market, we have a very clear view what a default is for a loan, not necessarily in the private markets. There a loan can be restructured multiple times without necessarily occurring a default ever. So again, there's some alignment between the public and private markets on the credit side that needs to happen in order for this market, I feel, to be fully institutionalized.
I do wonder though, so how do you go through, the supply chain that is private credit? I mean, is there some area, I don't know, I feel like the traditional big banks are looking to get, kind of more involved in it. So how do you go about, providing kind of the legwork, the framework, the due diligence, and again, in an area where we don't have a lot of oversight or a lot of information?
Look, one of the areas that we've been also focused on is looking at the regulated sector that at the end of the day either invests in, like the insurance industry, or lends to, which is the banking industry. So private credit could not really grow to the level it grows without one of the major investing classes are regulated industries, which is insurance, and without the leverage provided by the banks. So one way to improve that is for those regulators of those sectors to really have a sense of kind of the risks that they provision to the private credit market. And actually, the banking regulators in the US are making a very good stride. Starting in January of this year, the banks will be mandated to, for example, provide more granularity about lending into this market and the non-bank financials market in general, with better granularity. What is private credit? What is private equity, et cetera? So I think that will be a move forward. The insurance industry is obviously very heavily invested, particularly in the US. We estimate around 30% of the insurance industry is in some kind of way of alternatives, if you will, and that's going to continue growing based on the CIO surveys. So I think both of those industries have a very high vested interest in their regulators to help disclosures in the private markets.
Ana, from what you know about the private credit world, do you think it is wise that we look to open this up to more and more retail investors, accredited or otherwise?
Look, depends on the format. And actually, as a matter of fact, the business development companies are largely a retail product. But as I noted, those are, they're funded primarily, at least the rated universe, which we rate the largest, 30 plus vehicles in the space. They actually have a pretty good disclosures publicly to the public on a loan even level granularity performance, and also to the ones who actually provide for liquidity on a quarterly basis. We do in-depth analysis in terms of how much liquidity they have to have provision for that liquidity of, let's say, maximum 20% a year, 5% a quarter. So that you can plan for that, because that vehicle, again, doesn't have an ability to necessarily withdraw the money from a client immediately overnight, like a deposit or like an ETF market. On the other hand, the ETF market has daily liquidity. So there, the mismatch of that illiquid underlying asset class with a daily liquidity is something that is of our concern.
Which, of course, Carol, you're supposed to get compensated for when it comes to returns.
Right.
If you can't have access.
Right. Your assumption is that those returns are going to be,
better because
better
they're locked
than
up.
the overall market, right? Because you're kind of leaving your money there. I don't know. A lot to be known, and we'll see what 2025 holds when it comes to private credit. But it certainly has consumed our conversation on the investment side of things, really for at least the last couple of years, if not longer. Ana Arsov, thank you so much. Happy holidays. Global Head of Private Credit and Financial Institutions over at Moody's.
This is the Bloomberg Businessweek podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.